I'm a veteran, U.S. Army. Military taught me something about discipline, teamwork, leadership. Started a buy and build. I bought 34 companies then. Over the next 2 hold periods, multiple exits, sold it for over $1 billion.
Adam Coffey is the best-selling author of the Private Equity Playbook. With over 20 years of experience leading and scaling private equity-backed service companies, he has closed more than 58 acquisitions and built businesses worth over $1 billion. Super excited to have you on this call. So for those who haven't read your book or haven't seen any of your podcasts, can you share a little bit about your journey and how you got where you are today?
Sure, happy to. Seeing some familiar faces out there. So hello, folks. So for those of you who don't know me, my name's Adam Coffey. If I think about my life and background, I think about experiences that collectively kind of build to take us on our journey. I'm a veteran, U.S. Army. Military taught me something about discipline, teamwork, leadership. Engineer made me a meticulous planner. I'm a pilot. Pilots don't take off unless we know where we're going. And then we deconstruct the journey. Very useful skill later on in life in private equity, as a matter of fact. I then spent 10 years working for Jack Welch at GE. This is pre-tech. So tech doesn't exist yet. GE's Fortune #1 on the Fortune 500 list. Jack's the world's most admired CEO. And for a mid-30s up-and-coming executive, a great place to learn how to run a business. I then spent 21 years as a CEO, building 3 different national companies for 9 different private equity firms. I'm a turnaround guy. I'm a buy and build guy. So bought 58 companies, put them together to build my 3 empires. A lot of M&A experience. And then I got bored. I got bored. After 21 years of being a CEO, I needed a new challenge. So I hung up my CEO cleats. I started a consulting business. I work with private equity. When I work with PE firms, I help them identify risk in things that they're buying and help them determine whether they should buy it or not and how much they should pay for it. I work with 68 founders. When I'm working with founders, I help them eliminate risk so that guys like me working for the PE firms don't find risk and they pay up for the multiples. They pay a higher price. And I write books. I've got three #1 bestsellers out there. 4th book coming out in August, this month, August 27th, as a matter of fact. And then I teach seminars globally. So I work more hours today than I did when I was a CEO. So it wasn't retirement. It was about having fun and doing something different. I just turned 60. And so decided that for my last 10 years of my career, I was going to teach entrepreneurs how to make money using the tools that I've used, over the years. And so I think that covers it. That's pretty awesome. Much.
Yes. So there were 58 acquisitions in 3 roll-ups.
3 roll-ups and $2.4 billion in exits.
Nice. So I know I heard you speak about one of the roll-ups where there were 5 exits. I'd love to, if you could go from the beginning and then tell us just kind of like the anatomy of that roll-up.
Yeah, so that one was a very sexy company. It was a commercial laundry company. So, okay. Essentially we owned 70,000 laundromats across North America. But it wasn't just laundromats in the traditional sense, of which we owned hundreds. It also included 50,000 apartment complexes that had common area laundry rooms. So you own the building. There's no units in the washers and dryers in the units themselves. And so you have a common area laundry room. We would lease the space, do some kind of a revenue split, typically a 7 to 10 year lease. And then we would maintain the equipment. So when I started with that company, it was a family-owned and operated business, started in the 1940s by a husband and a wife. And at the time, it was called Web Service Company. And I could do a whole thing about branding just around that company. So 1940s, Webb means William E. Bloomfield, and the company was called Webb Service Company. Thus the confusion. When I come in to take over, first person outside of the family to run that business, and it's called Webb Service Company. And everybody invariably, I'm out on Wall Street. I'm raising capital. I'm doing my thing. People are asking me, what the hell is this? It's an internet laundry company. How does that work? So it was, it was a company kind of lost in time. First 5 years I was there, I modernized what I call a World War II battleship. So I started with a national company that had about 27 million in EBITDA. And I broke it up. I sold it off in pieces, went from national to a 3-state regional company, and then spent $17 million investing in technology to modernize this World War II battleship. And, long story short, by the end of the first 5-year period, I had 3 exits, and the company that I ended with at that time, 3-state company, out-earned the company I started with, and EBITDA was at about 57 million of EBITDA when I sold the last piece. Then sold it to traditional private equity and started a buy and build. I bought 34 companies then. Over the next 2 hold periods, multiple exits, sold it for over $1 billion to a company called EQT out of Stockholm, Sweden, and then left the industry.
Well, hold on. I want to understand that. There's like a lot in there. So the first 5 years, so it was a national company and it did 20 some million in EBITDA, and then you shrunk it to a 3-state. What drove that decision to shrink?
So I served shareholders, right? So I had mom and dad who founded it in 1947. This is circa early 2000s now. And first generation literally dying, second generation getting to retirement age, no third generation active in the business. So first time I met dad was when he passed away. I met him at his funeral. So they didn't want to freak him out by knowing that someone from outside the family was actually running the company. So I never met him. That they hid me from him until his funeral, which is when I met him. So during that time frame, I encountered a company that had no debt, paid cash for everything, and the East Coast operations were underperforming, and it was a density thing. So an example, in 13 states on the East Coast, they had 42,000 machines installed, in apartment complexes. I sold that because it's a route-based service business and there was not enough density to be profitable. And so West Coast was subsidizing the cost of East Coast. So I sold it. So the first transaction, I sold that piece. Family gets 42 million, something like that, for those machines. And, and liked it. It's like cocaine. Here's your first rock. Hey, that's fun. I like that 42 million. What about the central US? 108,000 machines sold for about 108 million. Back at the time, 110 million, a little over 1,000 a machine is kind of the price that stuff was selling for back in those days. And that's how they thought about value. So it worked good the first time. Let's do it again. And again, my theory was assets are underperforming, not enough density, and I've got a family in transition. So second transaction, 108 million. So hey, we've now put 150 million, something like that, in the bank. Love it. We now have a 3-state company that out earns what I started with. And then I spent 17 million investing in technology to modernize operations. And I then merged with my largest competitor in Los Angeles of 50 years, who also had 42,000 machines. So, drive 13 states on the East Coast for 42,000, or get rid of this stuff, merge with 42,000 machines in one city, Los Angeles.
Wow.
extreme density. So I had 8,000 apartment complexes in Long Beach, California. Great example. We were literally servicing 8,000 apartment complexes. My technicians could drive and park and walk to service calls all day long. That's how extreme the density was, very efficient. And then with the modernization, you know, I had a 42% increase in employee productivity. And, you know, great classic example is, you know, when I got there, service technicians and collectors, people going out to get money from all these locations, were using like a Dewey Decimal Index card system. So they had a card from a card catalog literally on their seat of their truck with little 3x5 index cards. And when we sign a new location, they would decide where to put it. When we lost a location, they'd take it out. And so a human was trying to decide what was the most efficient way to collect, you know, 50,000 locations in Los Angeles. And I put satellite tracking on vehicles. I used geocoding for all the customer locations. We then used algorithms and computer systems to decide what was the most efficient way to route, you know, these technicians in the collection and the performance of service, you know, invested in systems, et cetera. We did such a great job. I was on Microsoft TV commercials back in the day. Satya Nadella used to drag around a washing machine and a dryer and talk about all the sexy things that we were doing. I brought in data scientists, and we created polynomial regression models to determine at what was the optimal VIN price for each of our apartment complex, you know, mini laundromats and our laundromats. And so we were using technology to drive profitability. So the first 5 years was about asset diversification for the family, and then modernization. And then the family said, hey, this has been so much fun, Adam. If you can sell the last piece for X dollars, we'll leave entirely. And so I had a number. I went out, you know, on Wall Street, you know, went and brought in hired an investment banker. We ran a process and, you know, hit the number. And so sold the company. Family's now fully out in the first 5 years. So they made in total somewhere around 625, 650 million over those 3 transactions. And then I went from, you know, from private equity comes in now. And so I had modernized this thing, but now it's a different owner. So then I grew it back out, not just nationally, but then internationally. I invaded Canada. You know, and I bought, there were essentially like 5 main players in Canada, and I bought 4 of them, and I put them together. Their antitrust rules are a little bit different up there. And so I went from 0% market share in Canada to 90% market share of apartment laundry and laundromat in Canada in about a 2-year period. So grew it back out nationally then. So again, different shareholders, growth oriented. Now that it's dialed in and working, no reason not to expand back out. You know,
and it's all through acquisition.
34 companies purchased then in that last 10-year period, or 8 years and 4 months. You know, so first 5 years family, and then the next 8 years 2 different private equity firms.
And how did you build that M&A engine in that first company?
Yeah. So every company that I came in, you know, I walked into the industry, never having been in the industry. The companies had never been focused on doing M&A before. And so I had to build that team. You know, I kind of joke with people, and I tell them, I'm like John the Baptist. I'm one voice crying out in the wilderness. You know, it's like, we're going to turn this company around. We're going to build a strong culture. We're going to take the hill and grow like we've never grown before, you know, and, you know, then once I build that strong culture, you know, we're going to turn to also not just having strong organic growth and margin improvement, price increases, you know, things like that, but then we're also going to focus on doing M&A. And so I usually do 2 things when I walk into any company. First is I hire a buy-side advisor. A buy-side advisor's job is to build my funnel. You know, laundry's not as as fragmented as it once was. I'm doing three roll-ups right now in accounting, bookkeeping, payroll service type companies. And there's 1.8 million of them in the United States. And so to build a funnel, I need to know, where am I hunting and what does good look like? So I'll build, usually I'll call it, I call it my avatar. I'll build my avatar of what the perfect little acquisition looks like. My last company, I bought 23 companies. I was building an HVAC company, and on average, I was paying 5 times for 2 million of EBITDA. I did 23 transactions that averaged 10 million a piece. So I borrowed 230 million from the banks. The cash flow of the companies I bought serviced the debt that I needed to buy them. I then turn around and sell the combined companies for 14 times multiple of EBITDA. And so every dollar of EBITDA I bought and paid $5 for, I then turn around and sold for 14. I made $9 of profit. So round numbers, I bought 46 million of EBITDA, paid 5 times. That's 230 million. I borrowed 100% of it from the banks. I then put them together, sell it for 14 times EBITDA, 644 million, turn around and pay off the 230 million to the bank, put 414 million in my pocket, in my shareholders' pockets. So that's a classic buy and build. In laundry, I did that. I bought 34. And so, I start with hiring a buy-side advisor. I need someone to build a funnel. I then hire a VP of business development and put them inside the company. So I start with one person whose sole job is to do M&A, to help me, because I'm not going to be the guy who's going to be out hunting and convincing people. They called me Mariano Rivera. I'm the closer. They bring me out of the bullpen when we have an opportunity that's teed up, that needs to understand what a buy and build looks like and why selling your company more than one time might be a good thing to do. And so I come out, help them close. Over time, about a 5-year period, I build up a team of people in-house. So I walk into my into my HVAC company, nobody's there. Hire buy-side advisor, hire VP of business development. Within 5 years, I have 8 professionals doing nothing but M&A inside that company. And the first 3 years, I bought 8 companies. The next 2 years, I bought 15. So it's like priming a pump on a well. It's like you're out on a farm. It's like you pump until you're blue in the face and no water comes out. And then eventually the water in Texas comes up 700 feet, and finally gets to the head of the well. And then the water just starts coming out, and it keeps on coming. So building an M&A machine is it takes a little time.
Yeah.
It takes a little time to build up the momentum, but once the deal flow starts, it accelerates over time. So
that team is all internal, right? In-house.
Yes, and so
the buy side is in-house.
My 8 people, at my last company, I had 2 deal teams. Each one consisted of 2 people. One senior, kind of the deal maker, and then one junior, kind of the spreadsheet jockey. And so 4 finance professionals. I had counsel, co-counsel, and then I also had integration managers. And so I built that team over a 5-year period. And the reason is, if you go back to like bookkeeping, there's 1.8 million companies. If I buy 23 in 5 years, there's still 1.7978 or 77 companies left to buy. It's like, if you're going to do anything in life long term, then you want to own that process internally. So in any company I go into, it's a fragmented industry. I'm going to be doing M&A forever. It's never going to end. And so I want to own that capacity. I want to get good at it. I want it to become the intellectual property of the business I'm building. If I'm a small entrepreneur and I'm just looking for 2 or 3, I can teach people how to hunt. I can teach people how to, build and define the avatar of what the perfect acquisition looks like. Can help them get financed. When I left and started my consulting business, so I'm coming up on my 3-year mark. So my first client that I started working with, he had less than 2 million in EBITDA. He had 1.7 something million of EBITDA. He's in the managed services provider, MSP, internet, kind of service provider space. And he was worth probably, I don't know, $14 million. So in the last 3 years, I helped him hire a VP of business development. I helped him hire a buy-side advisor. I helped him get $40 million in financing. We've closed 6 deals. He now has $14.5 million of EBITDA. We've hired an investment bank. We'll sell for about $225 million. So in under 3 years, doing buy and build, no private equity money at the table, this single entrepreneur has gone from, call it net worth company 14 million to net worth company 225 in under 3 years using other people's money. And so he's my we're in the market now. After that deal's closed, he'll be my first full cycle from scaling, growth, M&A, build a team, exit.
That's awesome.
So
how do you go from a company that doesn't that's not acquisitive, culturally, into a company now that's growing that fast? How do you kind of, and it's a big earthquake to the culture. So how do you transition that company from non-acquisitive to acquisitive?
So if you just think about the companies that I'd go into in general, these were turnarounds. So I'm a turnaround guy and a buy and build guy. So if the companies were performing well, they would have never needed a CEO. They would have never brought me in. So my GE DNA is I'm a turnaround guy. So they would give me a crap company that's not growing, that's not working, well, and they'd hire me. And so my first goal and objective is build, a company, build a growth company, fix it. So I want to share my screen real quick.
Sure, yeah.
If I can.
Yeah.
You know what? I don't know if I'm gonna be able to pull this off. Let's see.
Yes, you can.
Yeah, but I'm on Chrome because that's what Google likes.
Oh, we lost him.
I hope to be that fluent and rolling up companies someday.
In
right?
no time. No time. And he's back.
Okay, I had to turn a setting on and it made me quit and come back. So
okay.
In order
Cool.
to do that. So I want to share this. I just want to give you an example. So here is the last company that I built. This was a nationwide HVAC and refrigeration service company. It was actually owned by, Edison Electric. So it was owned by a public utility.
Wow.
As a part of it had been in business for 40 years. As a part of deregulation, they spun it out and, they sold it. And for the next 16 years, it was owned by 2 different private equity firms. And it was growing, and they managed to get about 10% growth. And then here at this red line is where Adam was hired. And then you see the next 3 years of growth. And so I call this bending the growth curve. Jim Collins calls this the flywheel effect. And, ultimately, when I come to a company, it's underperforming. It's just not doing well. And the expectation is that I can do something with it. And so turnarounds start with, again, I'm one voice, one person. I come into a company that's underperforming. I start with culture. I build into people. Service businesses are about people, period. You can't store service in a box, put it on a shelf. Therefore, your product is people. So I start by building a really strong culture. And I build a place where people like to come to work in the morning. I get them to work harder than they've ever worked before and overachieve. I do this partially by investing in them, painting and articulating the vision of where it is that we're going to go, and it starts with just kind of brute force, and then we start to pick up momentum. And then somewhere in here, as I now have a company that's performing, I start the M&A process. But growth has to be balanced. We have to have organic growth. We have to have margin improvement, and then M&A is totally acceptable. But we can't be a one-trick pony. We can't be all M&A. It's just not it's not it's not going to be valued as much by the buyer universe if I'm a one-trick pony that's just growing through M&A. They want to see integrated. They want to see a collection of companies. They want to see an integrated platform with a story, and that story has to have multiple components of growth.
Nice. So when you do those buyouts, are the buyouts 100% buyout, or are you buying partial or merging competitors so they can also do an exit with you?
Yeah, I'm always buying 100% of the company, always. But what I've done is I create a holding company, and the holding company is acquiring the assets of all of these different companies that I'm buying. And, depending on the industry, I will make or let the former owners become rollover investors. So think about making that decision based on risk. Everything in life you do is about risk. So at the laundry company, I was signing 7 to 10 year contracts with my customers, as was my competitors. And, call it a real property lease for the laundry room, can't be canceled. So if any of you have owned apartment buildings out there, you've lived the dream of trying to kick CoinMac, or somebody, a laundry company out, you find out that you can't, it's impossible. And so because I have no risk of losing the revenue that I'm buying, I don't need the owners. I don't want the owners. So out of 34 companies acquired, I only let one stay. And it was when I bought my first chain of laundromats. I'm like, I'm doing laundries in apartments. Why the hell don't I own laundromats? And so I went out and bought a division, a guy with like 70, 80 stores, whatever it was, and I kept him. And I'm like, I let him roll over, become an investor in the mothership, help me build this division of laundromats. And so he stayed. I rotate forward, I go to HVAC. Although I had contracts with clients, usually they were 3-year service agreements, industrial service contracts, regardless of industry, all have 30-day cancellation clauses. You're not doing a good job, I can end the contract in 30 days notice. Well, if I'm paying a multiple of earnings to buy, this stream of income, and my customers can cancel it in 30 days after I buy it, I could be paying a bunch of money for something that disappears, in 30 days. And so I made the former owners become rollover investors. So I didn't let them leave entirely. I required a 10 to 30% rollover investment in my holding company, the mothership. So they're all down here, they own a piece, and then they roll over 10 to 30% into the mothership. Mothership keeps on buying more companies. And then when I sell, they get to ride my coattails and get a second payday that doesn't just include the growth of their company. It includes a piece of that arbitrage that I was talking about. When I buy their company at 5 times and then I sell the combined company at 14 times, they're getting a piece of that $9, in upside that I'm making. And so there is an ability, if you're an owner, to get multiple paydays where each payday is subsequently bigger than the last one that you got. So a lot of owners think of selling a company as a one and done event. I'm going to sell a company. I want my wheelbarrow full of cash. I'm riding off into the sunset. God bless you. If you owned a laundry company, I wouldn't have said a word. Yes, please leave, because I want to keep all the arbitrage. But in HVAC, I needed you to stay. I required you to stay. So I used rollover to make life, interestingly enough, for them to be good actors, not be bad actors. And so they had a vested interest in wanting to see the totality of the company succeed. And so I made them roll over, and then I would talk to them about, hey, look, selling your company, don't think of it as a one and done event. Think of it as the first rest stop in the wealth creation highway. And my last empire, I sold 5 times. That's 5 bites of the apple. That's 5 multi-million-dollar paydays for me, for shareholders. And, you can make a ton of money doing this. And so I had to educate them on the value of rollover investing and teach them that it was okay to be a minority shareholder in a buy and build.
Yeah. How do you keep them motivated and not checked out?
So money has an interesting impact on I'm gonna go back and pull up another slide. Give me just a second to find it here. Because I'm gonna give you a real life example from my last company. Okay, I want to show you a case study. So here is entrepreneur owned this first company. This was the first of the 23 HVAC companies that I bought. He sold me his business for 16.4 million. And he was the kind of guy who was like, if I'm not in control, by God, I don't want to own jack. I want it all, all or nothing. And I'm like, dude, Elon Musk, Jeff Bezos, two richest men in the world own less than 13% of their companies. You can be a minority shareholder and still make money. Besides, I'm not going to let you leave. I'm not buying your damn company unless you roll over, 30%. So the guy rolls over 4.4 million. Okay, Adam, I'll roll it over. God, I just hope I get my money back, right? 3 years later, after buying 7 more companies, okay, this says 13x. It was 13.5, so this one I went down 13. I was telling you 14. So in less than 3 years, it was actually 27 months later, I sell the company for the first time. Investors got a 4x multiple of invested capital. And so his first payday, 16.4 million down here, minus his rollover, because I don't want to double count his own money twice. So 16.4 first payday minus rollover times 4 equals 17.6. Second payday, bigger than first payday. In total, in 27 months, the guy got paid 29.6 million for a company he would have been willing to sell for 16.4 and walk away. So now he loves me. Adam, God bless you. I love rollover investing. He went off and bought a winery in Napa. He's not there anymore. I'm not there anymore. He rolled over 5 million more. I rolled over 13.5 million, and now we're both, call it passive investors in a company that we used to own, or be owners of, minority shareholders of. And when it sells next year, another chapter will be written, and so he rolled over 5. If he got 4 times, then 5 would be 20. 20 is bigger than 17. 17 is bigger than 16. And in total, the guy will have made around 50 million in 8 years across 3 paydays. So this is the power of rollover investing. And the only thing that makes it possible is arbitrage, which is naturally occurring in life. And so I don't need to buy fixer-uppers. I only buy good companies run by good people that fit my culture. I pay fair market value for them. I don't have to worry about underpaying, overpaying, because arbitrage is going to take care of my needs. And all I have to do is just do what the market needs me to do. Buy good companies, pay fair market value, roll them together, climb the PE pyramid, I call it, create a bigger company, which is rare. And just let me give you just a statistic to illustrate the point. So, what the hell? I've got a slide. Why don't I just put up the slide? As long as I'm not boring you guys.
No, you're great. But a quick question on that first one that you just mentioned. The first exit was for MOIC based on going from a 5 a multiple on entry and a 13.5 or 14.
Yeah, I'm
exit.
collecting companies that I'm buying at 5 times. I'm using 100% debt to buy them. And so I don't even have equity to service. I just have to pay back, debt and the interest. When I sell it, because I'm a bigger company, it'll make better sense when I show this particular slide.
Okay.
So I got to go into presentation mode if it will let me. I don't know if it will.
You're good. We see the slide now.
Yeah, but you're seeing the blue box.
Oh, yeah.
I don't know if I can do presentation mode while I'm inside here. Probably not. I wonder if I can when I do it this way. Okay. Are the blue boxes gone?
Yeah.
Okay.
They're gone.
Okay. In this pyramid, there is $6 trillion in capital. $6 trillion. Now, on the right-hand side, I've got 8,000 private equity firms. At the top, I've got companies like KKR, Apollo, Carlyle, Blackstone, companies you've heard of. Their funds are massive. They're on average between 10 and $30 billion in size. And then I got a whole bunch of PE firms up and down with smaller funds, at the bottom, bigger funds at the top. They all do the same exact things, same, identical. They all have funds that last 10 years. They all invest 6 to 8% of their fund size in one company, never more than 12%. This is about asset diversification. They build it into their charter. They have to buy companies in the first 5 to 6 years. That's how long their charter allows them to call capital from their limited partner investors. So they can buy stuff for the first 5 to 6 years. On average, they hold a company for 5 years, and then no later than the end of the 10-year period, they have to return all of the money back to their investors. And so as a result of the fact that they all are buying 6 to 8% or putting 6 to 8% of their money to work in one company, the natural reaction is there's 5 steps to the PE pyramid. And big PE firms buy big companies, little PE firms buy little companies. There's not enough time in a 10-year ownership of a fund period to put $30 billion to work buying small companies. It just doesn't work. So big companies buy big firms with big funds buy big companies. So if you're still with me there,
Yeah.
In the United States, in the bottom of the pyramid, there's 34 million just in the US, small companies in the bottom 2 runs of the pyramid. If you go to SBA.gov, they define small business as 500 employees or less, which means you can be pretty damn big and still be called small by the government. So 34 million small companies represent 99.9% of all companies in the US, and they employ 50% of the country's workforce. 34 million just in our country down at the bottom. But at the top of the pyramid, there's only 3,000 companies on the planet that have $1 billion in revenue. 2,000 of them are private, 1,000 are public. 2,000 are public, 1,000 are private. So you go from 34 million at the bottom, which is pretty damn clogged, to only 3,000 globally at the top. So what does that mean? It means as I get bigger, I become rare very fast. And when I become bigger, I'm rewarded with a higher multiple. So I call this my Velcro patch. And I can pop it off and throw it in a shoebox. And I can pop up a new Velcro patch and I can slap it on the wall for a given industry. So it could be property management, could be title companies, pest control, pick an industry, it's got a patch. I slap it up there. And what you need to know about the patch is that small companies trade for small multiples because they're plentiful. There's so many of them, there's not enough buyers, the prices don't go up. I'm doing bookkeeping. I told you there's 1.8 million bookkeeping firms in the US. And like the vast majority of them are in the bottom 2 runs of the pyramid. Mm-hmm. And so if I'm buying small companies, I pay small prices. So I buy 23 HVAC companies, pay on average 5 times. I climb the pyramid. I get bigger. Now I'm up here in this level. I'm above the 34 million. I'm rare. It lets bigger funds put more money to work and they pay 14 times for my company and I keep the arbitrage. This is what creates the wealth. The majority of the wealth that private equity firms generate comes from buy and build. It comes from, just the naturally occurring effect of when I buy small companies, I pay cheap prices. When I get bigger, I'm rare. People have to pay higher prices because there's not as many of me to buy at that size. They pay up. I pay off debt. I keep the difference. That singular issue is how the majority of private equity returns are generated. But the companies still have to grow organically. They still have to demonstrate that as they get bigger, their costs will go down and they'll create operating leverage. But when I do all 3 of these things, focus on organic growth, focus on reducing cost to serve revenue, and then add mergers and acquisitions on top of it, that's how I get maximum value.
What is your percentage of growth that you consider healthy for a company like this? That's organic growth.
Yeah. So let's just say, period, we need 30+% growth in a company every year forever. Remember that bending the growth curve that I showed?
Yeah.
That represents a company going from 10% growth over a 16-year period. It's growing, it's getting bigger. It's not setting the world on fire, but it's growing. To me, bending the growth curve and getting to a 34% compound annual growth rate. So Jack Welch taught me, if you can grow a business at 30% and maintain it forever, that company doubles in size in 2.8 years. It triples in size in 4.2 years. It quadruples in size in just over 5 years. That's how fast the world's largest company was growing. In the 10 years I was at General Electric, stock was splitting. The company was doubling in size every 2.8 years. And so this is earnings growth. Because it's earnings growth, which is all we care about, then that means that I'm growing top line, I'm improving margins, I'm getting operating leverage as I'm getting bigger, and I'm getting, call it then margin improvement. So margin improvement from a bigger company servicing, hey, when I have 1,900 trucks and I'm replacing 8% of my fleet a year, I get a lot better deal when I'm buying hundreds of trucks versus a small contractor buying one, or two. So as we get bigger, we improve our margins. As we get, grow organically, then I'm getting bigger. And then as I'm doing M&A, I'm also getting bigger. And so, if I'm a cook in a kitchen, I'm going to walk into my kitchen. I've got 3 components of growth: organic, margin improvement, and M&A to grow earnings. I want to grow at 30% or better. On average, I'm probably dialing up to teens, mid-teens for organic growth. That's price, volume, creating strategic pivots and cross sells, and then I'm getting 3 or 4 points of margin improvement. And then I'm sprinkling the magic pixie dust, which is M&A, on top, so that my concoction in the kitchen's yielding 30+% growth. So if I'm in an industry that's slower growth organically, I'm going to need more M&A. I'm going to need more margin improvement. So I maximize all 3 in order to produce the best tasting cake in my kitchen. But it needs to be 30+% or higher.
Nice. Okay. So that makes sense. So blended between all 3. That's what I was going to ask you.
And that's why I'm not focused on just revenue.
Yeah.
What I'm talking about here is we're going to grow earnings by 30% a year. I need more revenue to generate earnings. I need margin improvement to generate better flow through of revenue. And I'm going to use M&A. And incidentally, when I buy companies, I then get a second bucket of organic growth, because I get organic growth on the companies I buy during the time period that I'm building the empire. And let me tell you that I use science, when it comes to M&A. I don't just go buy shit. I buy good stuff, but there's science behind it. So as an example, when I started doing the buy and build in grocery, I wanted to figure out where was the best places to go and grow, inorganically. So I hired a team, an MBA team from UCLA, to come take a look at my existing customer base, track my 100 top logos. I want you to identify all of the MSAs or areas of the country where I am not today, but where there's the highest percentage of my current customers' logos and locations. And then I want you to put economic data behind it, because I only want to go into MSAs that are growth MSAs. So, people are moving to Texas, people are moving to Florida, certain metropolitan markets are growing at a faster pace. Some are negative. People are leaving some, and it's in decay. I want the tailwinds to push my growth. Show me where people are moving that has the highest concentration of my current clients. And then I set up a cross sell. So, hey, Target, I'm coming into this new region of the country, hadn't been there before. You've got X number of stores in this region. If you're not happy with your service provider, you can add them to my pile of stores. Then I'm looking at my Target, and I'm looking at who are the logos they service. And they're a small footprint company. And who do they service that I don't service? Let's set up a cross-sell opportunity. Hey, customer, why don't you let me do some of these stores and locations you've got back in my big territory that this company couldn't serve? And so I'm setting up all of these cross-sell opportunities. And on average, when I buy a company, it grows by 25% organically in the first 12 months because I make it a part of my integration plan. On day one, who is my sales team going to call to tell my existing clients about my new territory? Who on day one in the acquired company is going to call their customers to introduce my sales team to talk about our ability to service their problems on a bigger scale? And so I'm looking for cross-sell opportunities, where I can accelerate organic growth. And so now I've got the best of all worlds. Maybe I make a strategic pivot. So what the hell is a strategic pivot? So when I got to grocery store, refrigeration service company keeps grocery stores cold. 90% of its revenue's coming from there. That's commoditized. My largest customer is Walmart. If Walmart's your largest customer, you're the lowest bidder. That's not a good way to make a profit, build a profitable business. So I make two strategic pivots. I started buying engineering service companies that design grocery stores and helped my existing clients design stuff. They're paid like consultants, not contractors. And they have about a 55% gross profit margin, whereas my service company has a 30. And so higher margin, higher profitability, more of a consultative type sell, even at places like Walmart. Make another strategic pivot, and I say, okay, my guys know how to keep stuff cold. Who else would value that that's not in grocery, where I'm commoditized and it's a race to the bottom? Hey, I discovered pharmaceuticals. I discovered data centers, cellular telecommunication centers. Give you an example. Typical CVS or a Walgreens has $2.5 million in refrigerated pharmaceuticals. And if their stuff doesn't work, in 4 hours, they have to throw out their entire store's inventory and restock. And that's not an insured loss. They don't care how much I charge. They just want me there in under 4 hours fixing their problem. So pharmaceutical research facilities, data centers, cellular communications. Hey, out in Montana, when Verizon loses a cell tower, they have a 20-mile gap in coverage. So put in an IoT device, detect the slightest increase in temperature, and get your ass out here and fix it before I break down, and keep my cell coverage, up and running. So you discover areas, so call it red ocean versus blue ocean. Red ocean, bloody from competition. That was my grocery store, kind of refrigeration. We didn't leave. We've been doing that for 40 years. So we keep growing that. Yeah. But I focus on creating strategic pivots where my profit margin picture is different. I start buying companies and I'm sprinkling them across 3 divisions now. I'm cross-selling customers all my new capabilities. And end result is, rising tide lifts all boats. I become more profitable and I'm growing faster.
That's awesome. When you add that engineering or that element, that extra element that's high margin, doesn't that dilute the focus of the company, or it adds value to the company?
3 separate divisions run by 3 different division leaders. They don't ever know anything but their own wheelhouse. And so it actually raises. I buy 23 companies that on average had EBITDA margins more than twice that of my base company. And so my base company, that I started with, when I bolted on 23 companies, they were 23 higher margin companies. Net result is I have a bigger business with higher EBITDA margins collectively. That one division still has high margins when you look at it as a standalone division. Matter of fact, that division generated the majority of the company's EBITDA and profit, but it was doing work for my core customers. So now my core customers, I'm servicing grocery stores, I'm building grocery stores, I'm remodeling grocery stores. By doing their engineering, I now have a 2 to 3 year leg up on my competitors. I used to find out about a remodel when a bid was issued looking for someone to remodel a grocery store. Well, if I do the engineering, now I know upstream a year or 2 before the remodel actually happens, where my customers are going to spend money. And if I did the engineering, it gives me a leg up to do the build, or the remodel. And if I've done that, it gives me a leg up to do the service. And so it's all about, the hardest thing for any of us to get is a customer. Yeah. Once we get them, what else can we sell them? How can I create an ecosystem around my customer? There's 2 ways to do that. One is I literally sell the same customer new stuff, or I determine what my core competency is, like keeping things cold, and I take my core competency to a new customer set. So either sell more to the existing client that I've got a relationship with, or take my core competency to a new customer base. That's what I'm looking to do ultimately.
Yeah. Mo, you had a question?
No, just enjoying Adam.
Hey Mo,
Okay.
good to see you.
Good to see you, brother.
That's awesome. So if we go into the integration phase, what are some of the, like the elements that are very important to you in the integration? And then what are kind of like the phases of the change management? Are you like, focus on putting everybody on the same brand, putting everybody on the same tools, ERP, CRM, all that, or you have stages for that? So what's your philosophy on that?
So I'm going to talk about two concepts: integration light and integration heavy.
Yeah.
Or full integration. So golden rule number one: if you're buying companies, don't screw them up.
Yeah.
You're buying, a revenue and income stream, and you're paying a multiple for that. And so the worst thing you can do is destroy value, when you're trying to do integration. So with that as a backdrop, what I look at is what's easy. So there are buy and builds, people who build companies that's just a loose affiliation or collection of companies. And you can build $1 billion business doing that, and you'll be rewarded for arbitrage on some level. But next step is what I call integration light. So at my HVAC company, I didn't have great systems. We were going to take years to develop those systems, but I'm not going to wait. Doing a buy and build is like remodeling a 57 Chevy while it's going down the road, and you're hanging out the window doing body work while you're driving the car. It's difficult, but it's like, if you don't have good systems, doing full integration will kill value in the companies that you're buying. So integration light is kind of a halfway point. And so there I started by integration light. I'm going to integrate accounting, back office, HR, payroll, accounting, and finance type functions. And that's an easier lift. And so I'm at least going to get the synergies out of that. But if each of these companies is doing something different, or they have different systems or processes and procedures in place, if I don't have a scalable infrastructure, I'm going to kill and destroy value in the companies that I'm buying. So I decided, because I was still building infrastructure at my last company, we were going to do integration light, not integration heavy. And we were building that platform that we could fully integrate on. And so, my laundry company, remember, I told you, the first 5 years, I spent $17 million improving systems and technology. I had a fully scalable platform. I bought 34 companies. I kept one entrepreneur. I gave the other 33 a 1-year consulting agreement, and then off you roll. And I fully integrated because their systems and processes looked very similar to mine. And so I could easily integrate fully and capture all of the synergies, keep the worker bees, jettison 34 back offices, and leverage my back office. And so very, accretive to earnings when you can do full integrations. But if you don't have the systems in place, you're not a best-in-class company, you're not scalable, then don't try, because you're going to take a perfectly good working little company that you just bought and kill it by trying to integrate it into something that doesn't work. So simplify it, keep it simple, and only integrate that which is easy. And if you just suck everywhere and can't integrate anything, well, then I guess you're collecting companies while you're trying to build systems and platforms.
Yeah, absolutely. And so how do you see the same roll-ups that you've done in the past, whether it is the laundromat or the HVAC? How would you do them differently today if you were going back and do that same roll-up again? What are some of the things that you would do differently?
I had some really good outcomes. So I probably would not have done anything differently, but I will tell you that integration. So when you're starting out and doing M&A, even if you're doing it on a small scale, everybody in your company today has a day job, and integration doesn't happen by accident. It takes thoughtful planning. Think about every department you've got. Think about a giant Gantt chart. What are the things that need to happen and when? Well, if I'm doing an asset purchase of a company, then guess what? On day one, I have to hire all the employees that are coming over to work for me because it wasn't a stock deal and they don't have a job. I got to do new hire paperwork on day one. Well, guess what? I damn well better have bank accounts with money in them because on Friday they need to get paid. And so, it's like you can look at it in terms of I take every department, every function, and then I ask myself what must be accomplished on day one because that integration needs to happen pre-close. And then on other things, I can build a 1-year plan. So I've got pre-acquisition getting set up so that on day one, I have employees and they're going to get paid. And then I've got time, to do some of these other things. And so department by department, Gantt chart, who needs, what needs to have, happen. And if M&A is something that you're going to do regularly, like I do, then integration needs to be a full-time job for somebody, and so I hire eventually integration managers. And in the company, I may find that I've got good project management capabilities, people that work around IT, or work just in business, in the general, but they have really good broad understanding of business process procedures. I may convert some of them to my first integration managers, and we get better. The first integration is not going to be smooth. Matter of fact, I'll tell you, when you're doing a buy and build, it is not neat and orderly. It is complete chaos. Even when I'm buying good companies, it's chaos. And the train will barely stay on the tracks. And if it's going to fall off the tracks, then I got to throttle back just a little bit and let the company digest, what I bought. I keep things separate, though. Hunting and buying companies is separate from integration.
Yeah.
Once I get this pump primed, I don't want to turn it off because these guys are behind.
Yeah.
So if I've got the pump flowing, I'll buy companies and do what I call put them on the shelf. Buy them, put them on the shelf, don't touch them. But now I own them. It's clay for my potter's wheel, and I'll leave it in lumps up on the shelf until my team catches up, and then I'll start integrating. And so I'm not afraid to operate independently a company. But I don't want to slow down or throttle back M&A, waiting for M&A, for integration to catch up. If I do that, then all of a sudden I got a 6-month air bubble, in my snake where, I throttled back and now I have no momentum and momentum kills deals, time kills deals. So then I've got to kind of reprime the acquisition pump. So I think of the front end of acquiring companies separately from integrating, and I'm going to need to add resources on either side when one of those sides is creating a bottleneck that prevents me from accelerating and doing the volume that I want to do. Dirk, you had a question. What did Dirk say?
He said, how often, go ahead, Dirk.
Yeah, I was just wondering, like on these companies you're buying, especially like the HVAC type stuff, like how often are the key leaders staying in place versus you're having to turn these leaders within like 6 months to a year and bringing outside people in?
Yeah. So again, remember, it's all about risk. So do I have risk in the revenue leaving? And before I start looking, I build an avatar of what does good look like, and what is my profile? And that includes entrepreneur's age, where they're at in life, whether I'm going to make them a rollover investor or not, it's pretty detailed. So before I go look at 1.8 million accounting firms, I create an avatar of what the perfect acquisition looks like. And then I'm very disciplined from a buy side perspective. So because I had no risk in losing revenue, my strategy at Laundry was acquire company, give a 1-year consulting agreement, transition the business, shut down their back office and infrastructure, and get it on mine. And then, jettison entrepreneur. HVAC different, need them to stay, and or at least be like that, in a commercial building, that handle on the wall that says break glass and pull in case of fire. I need them around my ecosystem. I do that through the rollover investing. So someone who's 70 can retire, that's fine. I got to make sure they've got a good, strong number 2 in place to keep running the business, and or I got to have a bench of people that I could drop in. And so of the 23 companies that I bought in HVAC, something like 20 of them are still there today. I'm not, but 20 of them are, and so they're still there engaged because they're a rollover investor. and they're focused on getting the next bite of the apple. So where there's risk, I mitigate risk through how I contract and what I require. And that might shape my avatar a little bit differently for what the perfect acquisition looks like. So
Paul,
let me
yeah,
give you an example. I buy the first company and I'm passive. I'm not going to be the CEO. I'm just buying my first company. And so that avatar I need someone who's in their 30s, 40s, early 50s, because they're going to have to stay while I'm buying a bunch of others. And I need somebody to represent the company to the universe of buyers when it's time for exit, so that I can be the passive guy with the wheelbarrow full of cash and sneak out the back. But the avatar, once I buy the first company that has the CEO in place, that the guy with legs, my avatar now shifts. I want to buy companies from 60 to 70-year-olds who are looking to exit. I'm probably going to get it below market value. And all I need from them is just to help me transition, because I've got my young, stud or studette who's sticking around and is going to keep on growing. So I've got that person to run the combined entities. So my avatar for the first company may be different than second and subsequent companies, depending upon whether I'm staying in or I'm passive.
Yeah. Paul, you had a question?
I know time's dwindling. First of all, hi, Adam.
Hey there.
So I know we may not have time to touch on it, but Adam has awesome material on the 30-20-10, where it talks about 30% growth, 20% kind of like the margins, and then 10% profit. I think that was just a golden rule to use for businesses. And I think that's in some of your books and just some blogs that I've seen online. And he hasn't really talked much about it. I'll give him a shameless plug. I am part of his coaching program and joined recently. I actually said to myself, I'm not joining any more coaching, but I met with Adam one-on-one in Texas, had lunch with him not too long ago, and fantastic guy, knows his stuff, obviously. So I know Mo just mentioned something too, but yeah, so thanks for just
Paul, I appreciate you. It's glad to have you, in my group, again, I think one of the biggest problems small entrepreneurs, when I say small, I'm talking sub-billion dollars, right? So we're talking, people who are up and coming, building their empires. The biggest problem I see entrepreneurs make is they don't do enough diligence, and they don't know what good looks like. And they suffer from what I call a shiny penny syndrome. You decide you're going to buy something. You get so focused on wanting to do a successful acquisition that you overlook all of the obvious flaws. You turn on the lights and this girl ain't pretty, but you're just for sure going to make something happen. So you overlook everything, and it's like we need to do better diligence. We need to have more competent counsel. We need to be thoughtful about integration. You can get in trouble in M&A. But if you know what you're doing, massive profit to be made. And so Paul, what you were talking about is really just, it's a part of the profile. What constitutes a good business? And too many entrepreneurs go for fixer-uppers. And again, you're going to make money on arbitrage, not by fixing it. If you wind up buying a fixer-upper, I bought a bad company once upon a time. And for less than 5% of my revenue, it created 80% of my headaches for the next 3 years. Life is too short. It's hard enough to get 23 entrepreneurs to sing Kumbaya around the fire. They've never had a boss. I made them all rich by buying their companies. And now I got to get them all to work hard for me. That's hard enough. I don't need to at the same time buy 23 fixer-uppers that are dogs with fleas, hoping that I can fix them. It's like, don't buy crappy companies. Arbitrage is created by buying good companies naturally. And so we need to only buy good companies. And when you see a bad company, know what bad looks like. And that's the 30-20-10 rule. And when you recognize that a bad company is bad, run like hell. So it's like, I even find good companies from time to time where, like in HVAC, I wanted to pay 5 times. Now, the cheapest one I bought was just under 4. Most expensive was just under 7. But on average, I'm paying 5 times. But when I find a good company that meets all my criteria, it's the perfect avatar, and the guy says, I want 9 times. Well, God bless you. Good luck. I'm sure there's an idiot out there who's just dying to pay you 9 times. But it ain't me. Because I'm a disciplined buyer. Your company's worth 5x, and that's what I'm paying. So if that's not the good number, bless you. Good luck. If you don't find it, come back. And then I got 40,000 others to look at. It's like, I'm not concerned. about losing a good company because I don't want to stretch and pay a bad price. I buy good companies at fair market value. How do I know fair market value? I use tools. There's databases I can subscribe to for any industry that show what companies trade for. And here's 300 transactions in this industry in the past 5 years, and here's the averages they sell for at different sizes. And so I pay fair market value. Someone says my company's worth 9 times. No, it's not. The average company in your industry, here's 66 examples at this size sells for this. Well, my friend said he sold it for 9 times this. Well, 9 times what? And it's like there's so many war stories, that you hear at Rotary, or at your mixers, about I sold this company for 20 times. Well, 20 times what? And what did you sell? And it's like there's databases where this crap is recorded, that I can go look, because appraisers and banks need to know what a house is worth when they're going to finance it. And so there's databases I can subscribe to, and I can go query and find out. So discipline and learn the process.
Can you share with us the details on your program?
On my program, man, I work with people in so many different ways. Sure. So I do one-on-one coaching. So you're a business owner, you want to learn how to scale, do M&A, improve margins, and eventually exit. And I work with you one-on-one. And I have different levels of doing that. So I've got people who do it. For most smaller companies, I say, twice a month is fine. It's like you're checking in twice a month. And then I've got other people who bigger operation, or I'm working with multiple people on the leadership team. And so then I do a program where it's 4 times a month. And then I've got a peer group. So there's currently 38 members in my peer group, and they represent companies anywhere from $1 million to $150 million or so in revenue, multiple industries. I've got professional services like dentists, doctors, insurance agents. I've got blue collar home services type people in those cohorts, and they create sub cohorts. And there we do less one-on-one coaching. So, but it's like one session monthly, 30 minutes each. And then it's peer-to-peer, it's peer-to-peer, it's group learning, a couple days in person, in Dallas with me here, where I bring that group together and we work on things. Last year, we did almost think of it like an MBA type program. We were doing case studies. Everybody walked in rich, and I stripped all their money away, and they had to break up in groups and develop a startup. And where build a business plan for that startup, and we had kind of a case study competition type thing. But we do general learning, et cetera. And then I write my books. I've been on hundreds of podcasts, and all that stuff can be tapped into. I teach seminars globally, so I'll put 300 entrepreneurs in a room, spend 2 to 4 days with them, and just focus on all of this stuff, but in detail. And so it's my ecosystem starts with free, hundreds of podcasts. And if you don't know the tool, go to listennotes.com, listennotes.com. Type in my name, you'll find all the podcasts that I've been on. You can search by topic, you can search by industry, you can search by person. And so because I don't host a podcast, I appear on many. If you go to Listen Notes, it's the Google for podcasts. You can find them all on one list. Nice. And then, from there it's books. I call it my $15 hillbilly MBA. It's like 15 hours, $15, read my 3 books. That's better than $100,000 in most MBA programs, because most professors haven't built shit. They've never sold anything, and so for me, it's my Cliff Notes, on how to succeed in business. Then we move to the peer group, and then we go to one-on-one coaching. And, I think I've helped entrepreneurs exit for a collective value of over 300 million just in the last, 18 months. So nice. Some people call me an exit Sherpa. I climb Mount Everest every day. You climb it once, and so You know,
Nice.
I help you get a good buyer, a fair market value, and be happy, you know, in a rollover investment type situation.
Nice. Well, I
So-
appreciate you taking the time today.
Yep.
And definitely we'll love to have you again, you know, in a few months.